Most beginner and even intermediate traders like to use indicators for trading. In fact, a lot of people search for indicators on Google, YouTube. It seems to be an obsession. And yet, even though they're using indicators, they're losing money. And that's because they're using them incorrectly. So in this video, I'm going to show you how professional, experienced traders use indicators profitably to make money. And the dollars are in the details. So here they are. My name is Dr. Barry Burns. I'm the owner and founder of Top Dog Trading. And my dad was a stock trader, and he started teaching me when I was 8 years old. So I've been doing this for a while because I'm old now. And I'm also the author of Trend Trading for Dummies, published by Wiley & Sons, part of the famous Dummy series of books you're probably familiar with. And I've worked with a lot of brokerage firms, trading firms, and so forth, and I'm here to help you. So enjoy this video where I'm going to reveal to you how professionals use indicators profitably. Your pursuit for indicators is good, but most people are using them 100% wrong. Here's how most people use indicators, beginners and even intermediate traders. They just take some indicators from the list of indicators on their trading platform, put them on their chart, and they'll test one after another, after another, after another, and just visibly look at price, the indicator, and see which one works. None of them really work. And what most people are really looking for is which indicator is going to lead the market, the price action. And that leads a lot of people to then abandon indicators because they say, well, no indicators lead the market. All indicators are lagging is a common complaint. I'm here to tell you, first of all, that isn't necessarily true. And let me tell you what I mean. First of all, let's look at some different types of indicators. Which ones are lagging, which ones are leading, and even if they are lagging, how they can be helpful. I remember when one of my teachers first taught me that, and he said, you actually want to have a lagging indicator on your chart. I thought he was out of his mind, out of his gourd. So let's take, for example, a 50-period simple moving average on a daily chart. So that is one indicator I always have on all my charts, my daily charts, especially the 50 and the 200 SMAs. And why is that? Simply because, now, there's no magic to any of these indicators. Give up the holy grail. That concept does not exist. There's no holy grail indicator. But the market moves based on mass psychology. So one type of indicator you do want to have is something that everybody's looking at, the masses are looking at, because it's the masses who are moving the market. It's all that volume, it's buying and selling. And so when a lot of people, the masses in the market, are all coming in and buying off a level, or shorting off a level, or taking profits into a level, such as the 50-period simple moving average on a daily chart, that has a self-fulfilling prophecy. So there's nothing magical about it. It's just that, again, mass psychology, a lot of people are looking at it. So again, a lot of people take action, buy, sell, take profit. So you want to see that level so that you're aware that, oh, okay, all these market participants, they're looking at this level and they're probably going to be doing something here. And sometimes they will just hesitate. Market will come into that level. You get a little dojis or spinning tops, and there's hesitation. Other times, here's a really good tip for you. Sometimes the market will slice through it, especially if there's an emotional catalyst, some sort of economic report, news release, or whatever, and people get very emotional about it. But after the market slices the price through that, then it comes right back to that level after the emotion dissipates. And so that's often why when the market goes through those levels, I'll often trade them back to those levels. And the 50 simple moving average is one of the key ones. By the way, those of you who follow me, you probably already have my rubber band trade, but if you're new to Top Dog Trading and you don't have my rubber band trade yet, I give that away for free. It's one of my trade strategies. And that's essentially what it is. It's a reversion to the mean mathematical model. Really, the concept of the trade is when you get stretched beyond the normal, if you think of a bell curve, right, and the mean to that bell curve, when you get stretched to the edges of that bell curve, 2% standard deviations, then the odds are probabilities, which is what we trade, probabilities, then it kind of snap out back to the mean. And we use the 50-period simple moving as that mean. So if you want to get that trade, by the way, absolutely free, I give you a little tutorial on it. Just go to rubberbandtrade.com, pick it up, my gift to you. Now, we're not done. That's one type of indicator. So it's based on a statistical model of reversion to the mean type of trade. So lots of people like to trend trade, and I do too. Obviously, I wrote the book. And trend trading is great, but then there's the opposite side of trading, which is reversion to the mean type of trading. That is a very, very high probability win-loss ratio style of trading. Right, let's talk about some other types of indicators that can be very profitable in your trading. Another type of indicator is volume. And there's different types of volume volume indicators. Now, this is where a lot of people get mixed up. They think, oh, the volume at the bottom of my chart, kind of like, I don't know if you can see it here. Yeah, maybe you can see it in this chart on the background here. And you can see the volume bars at the bottom. That is actually not an indicator. The volume that you plot on the bottom of your chart is not an indicator. Just like the candlesticks here, these are not an indicator. That's called data. That's the actual data of the number of shares, contracts, or lots, and the plotting of the actual open, high, low, and close of the market. Indicators are different than data in the sense that indicators are math functions. So they are not the thing itself. They take the data from the thing itself, price, volume, other things. They run it through a mathematical formula, and then they provide a value. So you can't probably see it too well. I got a few indicators on there. We're not going to go through the details of these particular ones, but those indicators, again, they don't make us money directly. Otherwise, we'd call them money makers, but they do what they promise. They indicate something. They point to something other than themselves. Now, when we get to the topic of leading indicators, a lot of people say, oh, there's no such thing as a leading indicator. That's a half-truth. Because while it's true that there is no such thing that predicts the future in the market, there are things that will help us to see the energy of money flow in the market. And that's the whole key. If you want to simplify trading down into one simple concept, you probably already know it. Supply and demand. More demand than supply, prices go up. More supply than demand, prices go down. So it's basic economics on a chart. Right, so that's the core. And if your trading is not based around that, you're toast. You're lost. You will not make money because that's all trading is about. Now, we need to take that one a little step further because when we're trading, we're going to be asking ourselves, all right, here's where the market is at this snapshot in time. But to make money, I need to place a bet, a wager. I don't really like using gambling terms, but I'm going to be putting my money at risk. And that is a good term. Traders use that term all the time. So am I going to go risk on at this position with the probability, again, we're working with statistical probabilities. By the way, that's what makes trading different than gambling, is that it's not a game of chance. It's a game where we can have an edge and we're going to trade that edge. And it doesn't even have to be a huge edge. It just has to be a slight edge that we trade over and over and over and over again. So think about that. What type of energy of money flow would help us determine what might happen in the future and give us an edge, a probability? That energy, my friends, is momentum. And it's hard to see momentum in volume. It's hard to see momentum in price candles. And so this is why my favorite type of indicator is a momentum indicator. Well, let me give you an example of that. Use a little more example of a modern example of a bullet train. So this bullet train's going at 100 miles an hour and it weighs tons. So it has velocity, 100 miles an hour, it weighs tons. So velocity times mass equals momentum. So if you were to press the emergency brake on that bullet train, now, is it statistically probable that that train is going to boom, stop on a dime? No. So if somebody were to say to you, well, you want to place a wager on this, do you think it'll stop on a dime? Or if the train's going north, do you think that when that emergency brake is pressed, it will continue to go north a little while after the emergency brake is pressed? Well, obviously, the odds are, and they're pretty good odds, that is going to continue to go north. Now, it'll start to slow down, but because of the energy of momentum, it has so much momentum behind it, it's going to be very hard for that to stop on a dime. So we apply that same concept to the markets, but we're looking at the energy of money flow. Again, back to supply demand. But it's more than just are there orders coming in on the buy side, orders coming on the sell side. It's the accumulation and the building and the acceleration. That's another energy. So that, by the way, is another great point. That's what these indicators give you in addition to just looking at price and volume. They are taking all that data, and when you know how to read it correctly and you're using a correct indicator and a good indicator, they will show you acceleration of money flow. They will show you momentum of money flow. And if that's behind the trade at the moment you enter, that's the trade that I want to take. And that's pretty much what my trading is all about, is momentum. and getting in early on new momentum because, well, again, that's what gives me the odds of the market continuing to follow through in the direction that I take the trade. That, by the way, I've got an indicator for that too. Oh, that leads me to another thing. And I've got a proprietary indicator for you. Now, when I say proprietary, for full disclosure, transparency, what I'm doing is I'm just taking a common indicator that's available on every trading platform, but I modify it because you do want to use some common indicators, like I said, for example, the 50 SMA, so you see what the masses are doing. But that doesn't give you an edge, right? That just gives you a concept of, oh, okay, here's what the masses are doing. Here's the structure of the market right now. Here's where people are probably going to be buying, selling, taking profits. But when you want to get in, you want to have something the masses don't see. And that's where my proprietary indicators come in, because they give you an edge that other people don't have. Now, again, I give this away for free. If you want to check it out, go to indicatorwebinar.com. It's a webinar I used to do live. Now I've recorded it so you can check it out anytime you want. Again, I share with you how I modify the momentum indicator, and it works on any trading platform I've ever seen. I don't charge you anything for this. This is my gift to the trading community, meaning you. And this is what I use to get into every single one of my trades, and it works amazingly. My students love it. So go get those freebies, and if you like the video and you want to be notified when my videos come out on YouTube and other platforms, subscribe to the video and you'll be notified when more free tutorials like this come out.